Hello and welcome to this edition of Hardman Talks. My name is Keith Hiscock. I'm the CEO of Hardman Co, and I'm joined today by Jason Streets, one of the team of analysts here at Hardman. Jason has spent 40 years working in the stock market. It's great to have you here today, Jason.
The pleasure is all mine, Keith.
So we're here to talk about Cavendish. What can you tell us about the business?
Well, you and I have been around a long time, and in the past we would have described a business like Cavendish, which is the result of a merger in 2023 of finnCap and Cenkos, as a broker. And in those days, when we worked in those sort of businesses, we used to reckon that the day-to-day commissions plus the corporate retainers would basically pay all the overheads and the salaries. And any corporate action, IPO, rights issues, takeovers, whatever, would pay for the bonuses. Now, these businesses, and Cavendish in particular, have changed and are now rightly called investment banks, in my view. I mean, in the year to March 2025, only 10% of their revenue came from trading and roughly 20% from retainers. The balance, 70% odd, came from corporate transactions. And another change from our day, although more particular to Cavendish, is half of that transaction revenue came from private companies. So overall, it has 177 retained corporate clients as at March 25, of which 125 are on AIM, making it the largest advisor with 19% of the whole market. And it has 10% of all listed companies, main market and AIM, as clients. Now, in the private sector, it's also substantial. It's the 9th largest advisor by number of deals. But the market is much more fragmented and its overall share was only around 3%.
So your report came out just after the results were published. How did they fare?
Well, rather well, I think. I mean, they have a March year end. And in the 2 previous years, along with all their peer group, most of them have December year ends, they reported losses. Now, Peel Hunt, which also has a March year end and is the only listed competitor, reported their figures a couple of weeks before Cavendish, and they reported another loss in the same period. So Cavendish reporting a return to profitability with an adjusted PBT of 3.7 million, and with the private company corporate business doing particularly well, I think is a pretty good result.
So I heard you use the term adjusted profit. Adjusted for what?
Good question. Well, there was approximately 3 million of adjustments. The vast bulk of that is share-based pay. The other bits are a couple of things to do with the merger in the previous year. Now, I'm not a fan of ignoring share-based payments altogether, but Cavendish had 2 things in their favour here when adjusting it away. The first is that these are not unconditional awards at 0p issue price. They've got stringent terms attached and proper exercise prices. The second is slightly more esoteric but important, is that the way of calculating the cost that is put through the P&L is probably one of the least satisfactory parts of financial mathematics, in my view. The auditors basically use an option pricing model that just simply doesn't work for a small and relatively infrequently traded or illiquid share like Cavendish. And that massively exaggerates the true cost or the worth of those options, because options are priced on volatility. And the volatility is exaggerated by the illiquidity in the stock. So in this case, I think it really is worth stripping them out to get a much truer picture of what's going on. Of course, in our valuation, we include all the adjustments required for the number of new shares which will be issued. And meanwhile, the actual share-based payment, of course, is a non-cash item and so properly ignored.
So we'll come back to the valuation in a minute, Jason, but what's the market been like for Cavendish and how do you see that changing in the future?
Well, Cavendish operates in the UK small and mid-market company range. So companies valued at £1 billion or less. And that market has frankly been, as you know, pretty awful. We've had consistent outflows from domestic funds investing in UK equities generally and small caps in particular. We've seen the number of listed companies steadily reduce, and the number of new issues has declined markedly, although it seems to have arrived at a more stable, lower level. And we've also seen, until this year at least, years of underperformance by the UK stock market as a whole, and UK smaller companies in particular, and AIM being the worst of the lot. We've also had to contend with some additional uncertainty with the change of government, and there was some uncertainty about what would happen to the tax relief on AIM holdings. Now, that's passed. We now know the tax relief has been halved, which is better than nothing, but not great either. Having said all that, it does feel, and here I'm wearing my optimist's hat, that we may be at some sort of turning point. The UK market is very cheap by international standards, and we've seen international money flowing into funds, and we've seen quite a lot of takeover activity as international competitors have recognised the cheapness of the stocks in the market. And subsequently, we've actually seen some relatively good performance this year. We haven't yet seen any improvement in the primary market, although Cavendish completed 2 IPOs in April this year, i.e. in their new financial year, giving them a huge market share so far. And we might see some improvement in that later in this year, and if not, then maybe next year. And we've seen various initiatives by pressure groups and interested parties trying to persuade the government to deregulate or improve incentives to invest in domestic equities. Now, our forecasts don't include any expectation of improved circumstances. So if there are any changes that actually helped, that would be a bonus and is not already included.
Talking of forecasts, Jason, how do you go about forecasting for a lumpy business like this?
Well, I think it's worth pointing out that we believe that the private company transaction business is not as volatile as the public side. And so there's a slight smoothing effect from that portion of the business. And in fact, the company has just opened 2 new offices in Birmingham and Manchester. So we would expect to see the private side of the business grow as a proportion and introduce, more stability. But we can't get away from the general lumpiness. So getting back to the forecasting, what we basically do is we've used a pretty steady state for the trading revenues, although that should rise if the markets continue to rise. And then we've used a forecast for the number of corporate clients times the average retainer fee. The number of clients is gently declining, basically due to delistings, either takeovers or taking private. But the average fee is slightly increasing. And then we come to the corporate side, and what we've done here is we make an assumption on the number of deals we expect in the private side and the public side, and the average fee from each of those. And then we come up with an answer. And investors can find all the details laid out in the research report. But we have been a bit sneaky, Keith.
I wouldn't have expected anything else, Jason.
What we've done is we've published a forecast for March 26, which we think is very much a low ball forecast and should be pretty easily achieved, barring any major upsets. But then what we've done is for our 27 forecast, we've essentially done what we see as a sort of bullish forecast for 26. So if you take a more bullish view on the outlook for the UK market in general and Cavendish's performance against that backdrop, then you can essentially treat our 27 forecast as your bullish 26 forecast.
That's very neat. Now, finally, what about the valuation?
Well, valuation. Investment banks, are not rated highly because of their sensitivity to unpredictable markets. you'll find even behemoths like Goldman or Morgan Stanley only trade on about 12 to 14 times. On our FY26 forecast for Cavendish, at a price of 13p, it's trading on 14.5 times. But for our bullish FY27 numbers, that falls to just 8.5 times. And you keep a 6.5% yield for the ride. Now, I should add that of the 50 million market cap, 21 million is cash. So if you want an adjusted PE or an EV no-plat, those multiples fall to just 9.4 times or 26 and 5.6 times 27. Now, the only comparable listed company is Peel Hunt, and that is currently loss-making and is forecast to make a nominal marginal profit for next year. So there's no useful UK comparable multiples, or indeed European ones for that matter. So we have done a DCF, and that produces a central value of 18p using a 15% discount rate. Now, as with all DCF valuations for equities, we think they're probably more useful for looking at the sort of assumptions you need to get to a certain value rather than the other way around. And in the report, you will find a range of sensitivity tables to help with that. And if any investor wants to email me with some different assumptions they want plugged into the model, please feel free to do so. So I hope I've said enough to whet the appetite for viewers to look at the report, which they'll find, like all our reports, on our website, which can be downloaded for free.
Jason, thanks for your time.
You're very welcome.
So you can view Jason's paper on Cavendish, as he says, for free on our website, which is hardmanco.com. As always, thanks for watching. Please don't forget to like this video and join in the conversation wherever you're watching, and we'll see you next time.